as you mentioned, brand name activist investors down significantly last year. We're talking about names like Glenview, Third Point, Jana, Trian, Pershing Square, all losing money in 2018. On average, Brian, activists lost over 10% according to HFR. That performance is already leading to redemptions across the strategy. And as assets under management shrink, activists may be limited in the campaigns that they wage, says Lazard's Jim Rossman, who advises companies on what to do when an activist is in their stock.
If you've suffered outflows like that, it's going to limit your ability to, wage campaigns and the size of companies. I typically think about an activist portfolio as consisting of anywhere from 20 to 25 stocks up to 35 or 40. If you have limited assets under management, it's going to restrict the number and the size of the companies.
But those limitations will take a while to play out in the market. In spite of the sell-off that clearly dented activist returns at year-end, the fourth quarter was the most active Q4 by both campaign volume and capital deployed, according to a new report by Lazard. Nonetheless, a proxy fight can be harder to win when your competitor points out your own abysmal performance, Brian.
Okay, I have a question outside of the fact that why you're afraid seemingly to come to New Jersey. Anyway, how about this? Last year, all the volatility apparently hasn't scared off the activists that you cover. Why not?
Right. Activists are at their heart and core value investors. So activists saw this reset in valuations in the fourth quarter as more of an opportunity rather than something to fear. So they really deployed capital en masse. As I mentioned, it's the busiest fourth quarter of any fourth quarter in activism history. And the reason is because we saw such a significant sell-off that companies they'd been eyeing that had been too expensive, they suddenly had an entry point that made sense for them to generate better returns in the future for their investors.